Okay, we are actually, we plan to discuss this currency risk management. I mean, we have done on your course page, on your portal, you can find quite a lot of questions with currency risk management. I mean, this is a very important topic from your AFM exam perspective. So, but I have seen that sometimes, although we have done quite complicated or difficult questions, but still sometimes students are asking some questions which are very fundamental questions. So, I mean, we have done, for exam level questions, we have done many of them. We have done them from your past exam papers. We have done some questions from your practice kit. So I just thought that let's have a very quick look on very fundamentals, because some few basic concepts are still, I feel that they are confused. So number one, you understand that for risk management instruments you are using, number one is forward contract, future option, and swap. And of course, within swaps, you use sometime, I mean, within options, you use collars as well sometime. Now, forward contracts is very simple. There is no absolute complexity in forward contracts. Swaps are in exam. Swaps could be a little bit complicated, but mostly what they ask you in question is about futures and options. So you should be very much clear on futures and options. Now, if I talk about first very quickly in a minute about forward contract is just when you are actually these are executory contract, which means that the item which you will make a contract for, that will be delivered, the contract will be executed. It is between only two parties, you and the other party. It is not available in OTC. You cannot buy or sell it to other parties. So forward contract means, for example, if I talk about currency rate thing, and I need dollars, for example, I need to pay someone $1 million after 3 months, okay? So my home currency is not dollar. My home currency is pound sterling. And I'm just thinking that in next 3 months' time, if my currency, home currency, becomes weaker and the dollar becomes stronger, and I will have to pay dollar after 3 months, I will be making loss after 3 months because dollar will appreciate in value or my currency will depreciate in value. And I want to protect myself against that risk. So I go and I make a contract with some party that you will deliver me or you will sell me $1 million after 3 months. You agree the price with me today. And they say, okay, the price for $1 is 1.91, or let's suppose that if your home currency is dirhams, so they would say that 3.62 dirhams for each dollar. So you say, okay, let's lock the price. So what you are doing, you are actually fixing the price that $1 is equal to 3.62 AED dirhams after 3 months' time. And you are free from any kind of hassle. There is no gain or no loss after 3 months. 3 months will pass, this company will come in, you will pay them whatever dollars you need at the rate of 3.62, you will buy these dollars. So you are actually fixing the rate between you and another party, only one transaction. And this is the simplest of all. Sometimes it becomes challenging because you make a contract with party X. What if the party X does not honor their commitment? And after 3 months, you say, give me dollars for $1 million at 3.62 dirhams, and they are unable to deliver that. So this is a risk because only you and the other party is there, and the other party might not be in a position to honor their commitment. So that is one risk. Second is that they may say 3.62, they may say 3.66. This is not an open market. This is just the dealing between two people. So a lot of negotiation and suitability is there. That might be they are selling you very expensive. So it is possible that it could be expensive. It has a risk of default. These are the two drawbacks of making a forward contract. The good side is that it is very simple to handle. You just make a contract and you sit down and wait. When the time comes in, you go to the party, you take your $1 million at 3.62 dirhams, you walk out. No risk of gain, no risk of loss, price is fixed. This is forward contract. Calculation side is very easy. In exam, you'll just see how much $1 million would cost us. $1 million would cost us 3.62 dirhams. That makes me 3.62 million dirhams for $1 million. Usually the focus on exam is not on forward. They will ask you to calculate forward as well, but the mark allocation to forward contract is always a small marks because it is a short calculation. The problems start with futures. Okay. And then, of course, options. Now, in options, you need to do some additional calculations as well. But the basic philosophy, or you can say that the mechanism is same. The way you start calculating for futures, that is the same you use for options. So in options, you have to do two additional things I will explain you. But generally, 75% of the calculation is same. So if you understand handling the future transaction well, then options will look easier to you. So currency futures, this is something which has a lot of exam focus. And this is where students, they get stuck also sometime. Now, again, the same situation that $1 is equal to 3.62 dirhams. You have to pay someone $1 million in 3 months' time. And you want to hedge yourself, protect yourself. You talk to a bank or another party for a forward contract. And they said that they will charge you 3.66 dirhams for $1 million in 3 months' time. Now, you think that 3.66 is expensive, and you want to see the alternatives. What are the other alternatives possible? So one alternative is future, and we want to see that if going for a future transaction is suitable for me or not. So you need to make a comparison. You want to protect yourself. Somebody has already offered to protect, but they are asking 3.66 for this type of thing, and you feel that they are charging me too much, or probably you feel that there is a risk of default from the other side. Let's see if instead of using forward contract as my hedging tool, if I use future contract, what happens? So like I said that in forward contract, there is only one contract between the two parties. And that's all. Very simple. They will deliver you 3.66 dirham for $1. $1 for 3.66 dirham. But in future, you need to understand that there is not one-to-one relationship. There are two relationships, or two things will happen. What will happen, what you are scared or what you are concerned, that in 3 months' time, when I will go to the market and I would try to buy future dollars from the spot market, today it is 3.62 dirhams. In spot market, at that time, it might be 3.66, 3.67, 3.69. I am not sure. Something will be there. And you will buy it from the spot. You will buy it from the spot. And when you will buy it from the spot, there is a possibility that you will suffer some loss. To protect yourself against, so you have not asked someone, deliver me $1 million at this price. Because if you make this contract with someone, then it is a forward contract. In this case, what happens? That you say that I will buy it from the spot market, whatever it is, and there is a possibility that I might make a loss. And to compensate that loss, I will buy a future contract. I will buy a future contract. This is what we say we are going for hedging. This is what hedging is. And now, IFRS 9, hedging, the economic relationship should exist, and etc. What are the conditions for effective hedge? We are not going into those details because those are also related to this topic, but we discuss them in SBR, that a hedge, cash flow hedge, fair value hedge, hedge effectiveness. How do you determine what are the three criteria for hedge effectiveness, etc.? We are not talking about that. But what will happen? Necessarily what will happen if you make a loss in the real market, if you make a loss on the real transaction by buying the dollars at the spot, this loss will definitely be compensated with a gain on the future contract. Because when you buy the future contract, it also has some price or it also has some value. Now we go back, option pricing model. Okay, Black-Scholes. So there is a price of this future contract. This is a piece of paper which gives me a right. And actually it's a future, so it's not a right. When I talk about the future, it's an obligation. You have to execute it. So what will happen? I will make a loss here and I will make a gain on the other side. Or if I make a gain on the actual dollar purchase, like, for example, what will happen that when 3 months will pass, you go and you say that, okay, in the market, the dollar has depreciated and now I need only 3.60 dirhams to get $1. Oh, that is a good news. I will go to market. Instead of paying 3.62 million dirhams to get $1 million, you will pay only 3.6 million. You will pay less dirhams because dollar has depreciated, dirham has appreciated. So this, if this happens in 3 months' time, you are actually making a gain. And you should be happy that in the open market, from where I have to purchase dollars have depreciated or dirham have appreciated. So that's a good news for me, and I go for that. But the bad news is that you have locked yourself into a future contract, which works opposite to that. So if you are making a gain here, it is absolute necessary that you will make a loss here as well. Now, how much is that gain and that loss? They are not always equal. It is possible that gain is more, loss is less, or loss is more, gain is less, but they will nullify each other. They will nullify each other. And because you have entered into a future contract, you must exercise the contract. You must execute the contract. So you make a loss here. Okay. So what will happen? That a future contract does not mean that they will give you dollars. They are not going to give you dollars. It is just a tool to compensate the gain or loss which I make on the actual transaction. Dollars you will buy from the spot market. Like in forward contract, you don't buy dollars from spot market. In forward contract, I make a contract with Alpha. That Alpha, you will deliver me $1 million. And then after 3 months, Alpha will come and Alpha will give me dollars. I'm not buying it from the open market. I'm buying it from Alpha, and Alpha will deliver me. I don't care where the open market goes. So in forward contract, it is always one-to-one relationship. And I make myself locked with 3.66, and I don't care whether the market goes to 4 or market goes to 3. I don't make a gain. I don't make a loss. I only get my dollars at the fixed price, which is mentioned in the contract. This is forward contract. But in future, like I said, that you will buy a future contract. I'll repeat it again. You will buy this future contract as a separate thing. This is your actual dollar purchase from the market. This is separate thing. So you are not asking or committing someone, you have to give me $1 million at this rate. No. You say, I will see whatever will happen to market. Market may go up, market may go down. So I will be making either gain or loss. If I make a loss on my actual transaction, which is the purchasing of dollar, then there should be a gain here. Or if I make a gain here, then there will be a loss here. So whatever gain loss I make on my actual transaction in the spot market, that will be somehow, somewhat covered by alternative future contract. Okay. Now, how it will be done, I will explain you. Now this is how to say what happens with future. So like I said that you will be, if you made a gain here, you were happy that, oh, I made $100,000 gain. But then you say, I can't take all of that home because I have to settle my future contract as well. And on future contract, there is a loss of 70K. So my net gain is 30K. So at that time, you might have some regret. You might be regretting that why did I enter myself into this future contract? If only I had known that market would move in my favor, probably I would not have signed up a future contract. But unfortunately, it is too late. So you see a gain of 100K, you become happy, but a big part of that gain is taken away by the loss which is made on this future contract. This is the time you start regretting. You said, if I did not have this future contract, I would have taken all 100K into my pocket. And that feeling of regret would be there. Now, to avoid this feeling of regret, you say, can I just ignore this future contract and I don't execute it? Is there a possibility that I ignore this future contract? No, you cannot. Because it is a future contract which must be exercised. Yes, you did have an opportunity to sign up not a future contract, but an options contract. So in option contract, what happens? That option is an option. The name says it all. If you feel that it is in your favor, you exercise. If you feel that it is not in your favor, you will just let it lapse. So what will happen again? The same mechanism will happen. I need $1 million contract. I need $1 million in 3 months' time. I'm not sure what will be the dollar price in the open market in 3 months. So to cover my risk, I buy an options contract. 3 months passed, I go to the open market, and when I try to buy $1 million from the spot market, I see that the dollars have appreciated in the last 3 months. So I am making a loss. Oh, if I'm making a loss, what to do? I do have an options contract, and they also move in the opposite direction, which means if I'm making a loss on the hedged item, so there are two things, hedged item and hedged instrument. Hedge item is dollar, hedge instrument is option contract. So if I'm making a loss on the hedged item, which is dollar, there will be definitely a gain on the hedge instrument. So there will be a little bit of relief. I say, oh, I'm making a loss in the spot market of 50K, 50,000, but then my options contract will make a gain of 40,000. So I do have a net loss of $10,000, but at least I have saved 40,000 loss. So this option contract would help to minimize my loss. I will exercise it. I will exercise this option to retrieve that gain. But it is also possible that when I go to the open market has moved in my favor, dollar has depreciated, and I'm making a gain on the real transaction. I go to the open market. I said, I want to buy $1 million. What is the rate? They say $1 is 3.60 dirhams. Oh, I'm very happy. I make a gain. Now, if I'm making a gain, then definitely this is a gain on the hedge item. On the hedge instrument, there should be a loss. But because I have because I have my option contract, I can choose not to exercise the contract. I will say I will not let it happen. Let it go. Let it go. So I will not exercise the contract. So it means that all of this gain will remain in my pocket. I don't have to subtract the loss on the option contract. You never ever have loss on the option contract. There is no concept of loss on the option contract. I mean, you would be mad to execute a loss-making contract. You have been given an opportunity that if it is in your favor, you execute it, you exercise it. It is your option. If it is something which is not in your favor, just let it lapse and don't exercise it. So what happens that in case of option, if there is a loss, I will compensate it by exercising the options contract and taking the gain. If I'm making a gain in the real market, I will not exercise the option. Now that looks very fantastic to you. This is something very good. You say, oh, I need options then. Why should I go for a future? I mean, future takes away my, if I made a gain, big part of the gain was taken away by the loss on the future contract, and I had to take the loss. Option, you don't have to take the loss. In options, you just say, I'm not taking it. And the gain you can take, you can put it in your pocket. So then everybody should go for an options contract. Why somebody would ever think about going for a future? Option looks fantastic. I mean, it's just like if it is sweet, I will eat. If it is bitter, I will throw away. So the options give you this thing. But the thing is that in options contract, not every time options are suitable to you, because it is possible that options, when you need to buy option, you have to pay the premium. We call it option premium. Whether it is in your favor, it is in your loss, whether you exercise or you don't exercise, at the time of writing the option contract, you have to pay the premium. And sometimes that premium is very high. Sometimes that premium is very high. So when you make a comparison, you say that under future contract or under option contract, although options give me a right to choose or lapse, but options might look expensive. And you say, I'm not going for option because there is a lot of option premium inside. Okay. Now, when do we not go or go for option or future in real life? You see, we are actually protecting ourselves from risk. Risk means something which is like, okay, so there is a basic concept of risk and uncertainty, by the way. If I go back from the very beginning, zero, if we are starting. Uncertainty is something which you cannot predict, which does not have any past pattern, which you don't have any experience. I mean, if we are sitting today now in a lesson and suddenly there is an earthquake, it's an uncertain situation. It's not a risky situation. It's an uncertain situation because it is unpredictable. You are walking on the road and then there is a brick which fell from somewhere up from the building. And it actually just, I mean, I'm not sure if it hit you or not, but that's an uncertain situation. There is no, you can't predict about it because there is no past pattern or past experience of that. Risk, on the other hand, is something which we do have some experience. It does have some probability. You know, if I ask you, what is the probability of a brick falling from 5th floor onto your head? What is the probability? Can you assign any probability? You cannot. If I ask you, what is the probability of, I mean, that tomorrow there is earthquake? You can't assign any probability to that. It's an uncertain event. In case of risk, we do have this opportunity, because we have some past experience, we can predict something and we can assign probabilities that this thing has a chance of happening 10%, this event can happen 20%, there is a 30% probability this thing can happen, there is a 70% chance that this thing will happen. So when you can assign probabilities or when you can start predicting, that becomes risk. Now, sometimes what happens that you get stuck, you don't know whether it will move this way or that way. Like, so there are different types of situations, and they will tell you actually why I'm saying that, because many times the exam question will also start speaking like that. They will say that, for example, I mean, you guys all are accounting finance people and you are working, some of you are working professional as well. You're aware of your country, you're aware of your economy. Now, as I'm speaking, all of you people have your own local currency in relation to dollars, and you are predicting, your mind has already started thinking about that thing. What is expectation in your local currency? Is it expected that your local currency will become stronger against dollar? Let's suppose if I think like sterling, and if I talk about dollar. So in next 2 months, what do we expect? So based on UK economy, based on the inflation levels which we are facing in UK, what do we predict? What has happened in the past 3 months and what is expected to happen in the next 3 months? Do you think that there is, by any chance, there is a possibility that sterling will become stronger? You would say that, yes, I think that there is 70% chance that sterling will become stronger, and only 30% chance that dollar becomes stronger. This is one situation in which risk is there, but you still are in a position to predict something, that there is a big possibility this will happen. Sometimes, on the other hand, you are in a situation that if I ask you that in next 3 months, what do you forecast, what do you predict, whether sterling will become stronger or weaker? You say it can go either way. Not sure. Maybe it goes up, maybe it goes down. So risk again is here. Probably the best way to say is, you would say it is 50-50. So that is another risky situation. So, I mean, one risky situation is 70-30. One risky situation is 50-50. Now, in real life, what happens that when we know that it can move anyway, 50-50, we go for the options contract. Because we don't know whether it will go up or it will go down. So we say that we want to keep that option of letting it lapse. But when I'm in a situation where I can fairly predict, I cannot 100% make a commitment, but I can fairly predict that my local currency is going to go up or is it going to go down, then I go for a futures contract. In such a situation, I go for a futures contract. Okay. So anyways, and of course, if there is a situation which I just want to avoid any gains and losses in future, then I go for a forward contract. Now, very quickly, some specific features or characteristics of 3 things, forward, future, option. What are the advantages or disadvantages in 2 lines? Because they will not ask you in exam to write a long note on that, because mainly the risk management question, most of the marks are allocated to calculation part, but they do ask you sometime a 5-mark or 4-mark question, that which tool or which instrument should be used and why. And it should be in your mind as well. So first, forward contract. Forward contract is easy to write. Forward contract is flexible because it is between 2 parties and you can write down any standard date, any amount. Customized date and customized amount. You can make a forward contract for, I need dollars in, 43 days. And I need $940,000, 940K USD in 43 days. I can make this contract with someone because forward contract is between me and the other party, 100% customizable, available in almost all currencies, all major currencies. I can make it for yen, I can make it for euro, I can make it for sterling, I can even make it for INR Indian rupee. I can go and ask with my bank to make it for me in dirhams. So currencies here are flexible, amounts are flexible, and the time period duration is flexible. But the risk is that other party can default. And number two, it might become expensive because it is the choice of the other party what price they will give me, because there is no market price of that, because it is not available in the market. It is not available in the market. I have to go walk down to someone and ask them that I want to make this thing. Please tell me your offer. And they will sit down and say, oh, it is 3.63. I say it is too much. Okay, let me make it for you 3.625. No, please make it 3.61. This thing will happen in forward contract. Negotiation will happen in forward contract. It's not an open market thing. So this is forward contract. Flexible, made to my needs, but expensive, could be expensive, and risk of default. So you have to write down if it comes in exam. When it comes to future, it is cheap. There is no specific higher premiums or fees attached to that. It is cheap. No risk of default. Default risk is not there because when you will do the questions, you will see marking the margins, and parties who are making the contract, they have to add up markups, etc. We did some questions. So it is open market. It is available in OTC, open market thing. So, and that's why prices are fixed and standard amounts and standard days. So I cannot tell someone, I cannot buy a future contract for $940,000. Future contract is available in $1 million or $500,000 or $1 million. Standard amounts are there. Standard time periods are there, 30 days, 60 days. It is not possible 43 days, 47th day, the evening of the 48th day. Nothing will happen like this. So standard amounts are there. Standard days, durations are there. These are two disadvantages. These are disadvantages from my point of view, because I need $1 million and they offer me, no, I need 940. They're offering me $1 million. So it's a disadvantage. But the advantage is that it is cheap. There is no risk which is attached. It is almost risk-free, and it could be cheaper, possibly. This is for futures. The same conditions will apply to options. The same conditions will apply to options with one additional advantage and one disadvantage. So options, they also are futures, but you can call them extended future. You can call it future, version 2.0. Okay, an option is just an extended form of a future. Option is not something different. I mean, it's not something unique. It is different that future, amended future or upgraded version of future is called option. Just an upgrade version of future is called an option. And option will bring one more advantage, but there will be one more disadvantage. One more additional advantage of option is that you get the option whether to exercise or not. So you know that if it is making a loss, if I already have made a gain in the real market on the real transaction, loss I can avoid by not exercising the option. So that is one big advantage. And the disadvantage here is that you have to pay premium for that. Converting a future into an option means that you have to pay premium for that. So these are the advantages and disadvantages from a very basic level for options and futures. Now, there are 3 steps I've actually, I mean, I have done quite long questions with you people, exam style questions. Like there are so many videos on option and future questions, scenario questions, where one question has, I mean, it took us maybe 1 hour and 20 minutes, 1 hour, 30 minutes long videos you already have. So I'm not going to do those complex videos here today. I just want to show you the very basic, the beginning, the starting point again, once more. Okay. So I have picked up your book. I've shared the book with you. So in future hedging, 3 steps we should remember: 1, 2, and 3. Step number 1, contract should be set in terms of either buying or selling the future. The same will happen in your options as well. And this is one tricky part in option: call option, put option. Some students, they get stuck. Anyways, buying or selling the future, contract currency, closing the closest standardized future date after the transaction date. I will explain you. Step 2, go to the actual spot market and buy your transaction. And step 3 is close your future transaction. So let me just tell you again what happens. You know that you have to, you need dollars in 3 months' time. So what you do, you go to the actual market and you make a future contract. First step, you make a future contract. Second step, when the time comes, so this is what you do today. Then what happens? You buy the dollars from the real market after 3 months. Let's do like this. So 3 months later, you buy dollars. You buy dollars. This is step number 2. And when you buy dollars, you will be making some loss or you will be making some gain. So same after 3 months on this date, you will reverse this transaction. You will reverse the future transaction. And as a result, if it is loss, you will make a gain. If you made a gain here, you will make a loss. So this is what happened. Probably you have done buying the future. If you have done buying the future, here you will do sell the future. This is a contract to buy, and then you will sell the future so that you can settle it out. So 3 steps will happen. So 1 is I enter into a futures contract, and that becomes my liability, or that becomes something which I need to settle. I go to the market, I buy some dollars in this real market, and I make a loss here. That loss will be settled by the gain when I will close this transaction. Let me just show you one example here. 3 steps, very simple, okay? And the same 3 steps you will do in options contract as well. But for doing that, there are 2 additional things which you need to decide in option questions. 1, you always have to see that do you have to, is it a buy option, call option or put option? Are you going for a call or a put option? And you should be skilled enough to decide, am I supposed to go for a call option or a put option? I have explained that in a very great detail in your currency future lecture number 7. Go and watch video lecture number 7. I've explained that concept there. So either going for a call option or a put option. And the second thing is you need to calculate how much premium I have to pay. And finally, you need to calculate your overall gain loss, overall total cost of the transaction. That's all. Other things will remain same. So let's see, like I said, that if you understand this futures hedging process or procedure, whatever you may call it, if you understand it clearly, other things will be easy. There is this word which is called tick. You can solve questions with using the tick method, or you can avoid it, the tick thing. I will explain you the tick as well. Any question until here, please ask me. Otherwise, I will start doing this long example. Okay, some terminology which you need to first understand. Number one is that there is an amount which you have to protect, okay? Let's suppose that you want to protect yourself like $1 million, or let's call it, let's call it $1 million. But dollars is not something which is your home currency. Throughout our course, we will assume that our home currency is pound sterling, unless they tell us, generally speaking, this is my home currency and this is my foreign currency. Okay. I have to pay someone $1 million. This is the same number I have been speaking for the last half an hour. So the question is that how many contracts should I buy? What happens that these contracts are denominated in fixed amounts. Like I told you that fixed amounts are there. So you will be offered contracts. For example, one contract is 125,000 sterlings. Now, this is $1 million. So you divide it with some given number, whatever the number is, whatever is the spot rate for today, let's suppose. And you find out that as of today, if I divide it with 1.4, let's call it like this. So as of today, 1 million divided by 1.4, it makes 714,285 pounds. So actually, this is the amount which is at risk, and I need to protect it. So then for 714,000, I cannot go and do it in one go, because I have to protect it through, I need to buy some contracts. One contract is 125,000. So I divide this with 125,000. And that makes me 5.71. If I round it up for the sake of simplicity, I need 6 contracts. So actually, I need to enter into 6 contracts. So whenever you start with option and future question, the first thing is you have to decide that whether it is a buy contract or is it a sell contract. Now, in your case, because you have to make payment to someone, so you need to buy dollars. You need to buy dollars. Okay, this is one confusion which always students they ask. So please listen it carefully. What is the scenario? Let me repeat it again. You have to pay in USD in future. To pay USD, you need to buy dollars. You need to buy USDs. So a lot of times students, they think that, oh, it is a buy contract. It is not a buy contract. You don't have USDs. To buy USDs, actually, you always think like your home currency. What is your home currency? Your home currency is sterling. So you are actually selling the sterlings to buy USDs. So you need to have a sell contract. What you need to enter here, this is the starting point to make it sure, clear in your mind, because a lot of students are asking, am I going for a buy contract or a sell contract? You're going for a sell contract. Sell what? You only will sell something which is in your hand. What is in your hand? You have sterling in your hand. So you will sell sterling to buy USD. Because you need to buy USD, you need to pay USD. To pay USD, you need to have USD in your hand. And to have USD in your hand, you must sell your own currency. So you are going for a sell contract. This is step number 1 on this. Step number 2 is that how many number of contracts do I need? The number of contracts. And number of contracts, I just showed you that, okay, to get $1 million, how many sterlings are needed? Each contract sterling is 125. So I need to have 740,000 sterlings. Each contract is 125. So I need 6 contracts. Okay. This is the second step you always decide on, the number of contracts. Then this is called tick. Like I said that you can live with or without the concept of ticks. It is better to understand. Tick is the movement, the smallest movement which we assume in the market, in the value of the contract. And this is actually 4 decimal places. Okay. Like in currency rates, always expressed in 4 decimal places. Okay. Like if I said that I told you that $1, 1 USD was equal to 3.62 dirhams. This is not correct actually, because currencies are always in 4 decimal places. 3.6214. They are not 5 decimal places. There are not 3 decimal places. Currencies prices are expressed in 4 decimal places. So a movement of 1 here, 6215. So this is called 0.0001. The movement has come to 1 point. This is the smallest movement in the currency market. And it is 4 decimal places. So this one is called 1 tick. It is called 1 tick. Okay. So if I have got a contract of 125,000 pounds, and of course, sterlings and dollars are represented in 4 decimal places. And if I say that the value has moved 1 tick, it means multiply it with 0.0001. So that will give you an answer, sterling 12.5. So 1 tick, if a contract size is 125,000, then the value of 1 tick is 12.5. For instance, if the value of the contract is $100,000, 100,000 sterling, for instance, then again 0.0001, it will become 10 pounds. It will become 10 pounds. It means that if there is a movement of 1 tick, and you have got you don't have $1 contract, your contract is 100,000. 100,000. So 100,000 times 0.001, it means that there is a 10 pound difference or 10 pound gain or loss, whatever is on 1 contract. Okay. So if I say that there is 1 tick, it is 12.5. If I say that the contract, there is a difference of 2 ticks, then 12.5 multiplied by 2. On each contract, there is a gain of 25. If I say that there is a 10 tick, there's a 10 ticks difference in the price. So 10 ticks means 12.5 times 10, 125 on 1 contract. How many contracts you have? Oh, I've got 6 contracts. So the total gain or the total loss on that would be 125 times 6, which is 750. So now you should understand that tick is the movement in the contract value. The smallest movement is 0.0001. You have to multiply it with the contract size. And then you have to multiply it with the total number of contracts you have to find out your gain or loss overall. So let's suppose my contract size is 125,000. And I have got 40 contracts. And then I multiply it with 0.001. So how much it makes me? 125,000 times 40 times 0.001. 500 is the difference. 500, whether it is, if it moved in my favor, my gain is 500. If it moved not in my favor, 500 is my loss. This is one way of calculating it. Another way of calculating it, that 125,000 times 0.0001. So the price of 1 tick is 12.5. 12.5, price of one tick. How many ticks you have moved? You have moved 40 ticks. So 40 multiplied by 12.5, again, it gives you 500. So there are two ways. I don't use this method. I use generally this method. To me, it looks more simple. I say, what is, so it's 0.001, it is standard thing. We always know that. This does not change. I only need to find out what is the contract size and what is the contract numbers. And I multiply these three things. I find out. This is the method I use mostly if I am using the ticks thing. Alternatively, sometimes what they do in the book, that they find out the price, the value of each tick. So instead of using 0.001, they find out the value of, so they find out this thing together. When you multiply these two things, you find out the value of one tick. Oh, one tick is 12.5. This is what the traders, they do in the market. Traders, they use this one in the real market. How much is the size of one tick? Value of one tick. One tick is 12.5. How many ticks you moved up or how many ticks you moved down? That's what you find out. So this is very, this is actually the academic way of doing it. And this is the market way of doing it. You can use any one of them. Okay, so you understand tick, you understand contract size. We have a very simple question with us, just to see this knowledge into application at the simplest possible level. At the simplest possible level, okay? More than this, I mean, simpler than this, you cannot expect yourself. And I don't think this will ever come to exam this much simple. Yeah, but this is something which is part of a bigger calculation. So your total calculation in exam will be this much, but this calculation which I'm doing now, it is this part. So this is exactly what you will do in exam, but this is not the only thing you will do in exam. You have to do this one also in exam and this one also in exam. So this is exactly what we will be writing in exam. But in exam, they will be a bit more as well. They will add some spice. Let's see the question. It says today is 31st of December. Spendo PLC anticipates that in 2 months' time, it will need to pay for purchases $11 million. The exchange rates on 31st December are spot rate, which means if I go to the market today, I can buy $1.9615 per pound. So if one sterling is 1.9615 as of today. In the market, they have given us future rates, dollars per sterling. Contract size is 125,000, which is offered in the market. I cannot buy more or less. Minimum, I have to buy one contract, which is 125,000 sterlings. And if I buy the contract for March or for June, the price is 1.9556, 1.9502. Now, if you see what is happening, actually dollar is becoming stronger because today you have to give $1.96 to buy one sterling. They are expecting that in March you can give $1.95, which means you will give less dollars to buy 1 pound. So dollar is actually appreciating in this scenario according to expectations. The expectations are that sterling will become weaker, dollar will become expensive. Okay, like for one sterling, today you can get $1.96. The expectations are that in 3 months' time, one sterling will only be equal to $1.95. So sterling is becoming weaker, dollar is becoming stronger, and I have to pay dollars. Oh, that's something which is interesting. $11 million. Just before we do any question, any calculation, you need to kind of, many times because we do not play with the scenario, we don't understand it. Let's suppose, what is happening? If I go to market today, so I have to buy $11 million. And at today's price, it is 1.9615 sterlings. So I need to, I'm not solving the question, I'm just playing with the question. I need 5.61607 million. I need 5.607, or let me call it 5.61. To make it simple, let me call it 5.61 million. I need 5.61 million sterling from my bank account and convert them into this amount. The market is offering this thing. Let's suppose that this is what is given to me in the market. This is exactly what happens. This is the, this is the rate. This will become the rate because this is what the market is expecting. So in 3 months' time, if I convert it at 1.9556, now see how many sterlings I would need after 3 months. 11 million divided by 1.9556. I would be needing 5.62 million. So there, actually it is 5.624. It is 140,000 difference. So I would be needing more money. Oh, that makes me concerned. That makes me worried because sterlings are losing strength. I would be needing more sterlings to buy the same 11 million. I will be at loss. The market is giving me signal that dollar will strengthen, sterling will lose. If I don't enter into it, either I pay someone today, or if I am waiting for 3 months' time or 2 months' time, I would be needing more money. Instead of 561,000, 5,610,000 sterlings, I would be needing 5,620,000 sterling. 110,000 sterlings I need, 100,000 sterlings I need more. So that is actually which is making me worried. So I say, okay, I need to go for a contract. Now, what is given? Either I take this one, March, or I take the June. The rule is that the date which is immediately after the transaction date you have to pick up. After, not before, after the transaction date. So for example, when do you have to pay? This is 31st of December, and you have to pay in 2 months' time. So December is already gone, January and February. So this is January and February. So after this one, and by the way, when they say that these prices are March, this is not beginning of March. These are always end of March. This is end of June. This you should remember. They say March. So when you say March, is it middle of March, beginning of March? No, it is end of March. So the rule is that you have to pick up one which is after. I'm writing it down here so that you have a visual memory. You don't forget it. After the transaction date, immediately after the transaction date, and that is March. Now, it is quite clear logically when they said that you need this money in February. So basically students can think like, oh, I have the transaction in February, so I logically should go for March. Why June? Why should I skip March and go for June? There is no reason for that, okay? So everybody will pick up March automatically. But a confusion can create when they say that you have to pay in 4 months' time. So when you have to pay in 4 months' time, this is April. And April somewhere comes in the middle. Now you will start thinking, should I go for March or should I go for June? When February was here, it was an absolute choice that you go for March. There was no logic of jumping to June, okay? But if you come in the middle, if the question says you have to pay in 4 months, and 4 months means January, February, March, April, I have to pay in April. Am I going for March or am I going for June this time? Remember the rule after. You have to pick up the future, which is after, immediately after the transaction date. So after April, in this case, you would go for June. If they say 4 months' time, you should be taking June one. So now, in this case, we are going for March. So what is happening? This is a future transaction. I need 11 million. I will purchase from the market at the spot rate in 2 months' time. And there might be some loss because dollar is becoming expensive. And to protect myself, I need to enter into another transaction with another party for future contract. So any loss which I make on my actual dollar purchase, some loss, some part of that loss, I will recover from my second transaction. This is the idea. So now, how do we execute that? It says calculate the outcome. Now, what does that mean, outcome? I will explain you, because that is an interesting word, outcome. Outcome means everything taking consideration of. Because this word outcome, when they will use the word outcome in options question, you will have to plus minus many things. So outcome is considering all things like premium paid, loss made, gain made, everything together. Calculate the outcome of using a future hedge in 2 months' time if the spot rate is 1.990 per dollar and the future rate is $1.988. Now, what is happening? If the spot rate in the real market goes to $1.99, which means that this $11 million which you need to purchase, you will purchase these 11 million at 1.99. Okay? Not at 1.96, not at 1.955. You will go to the market and actually really buy your dollars at 1.99, like $1.99 per sterling. This is the purpose of spot rate. And June I have ignored. This is what I have it here. This is my future. So this future price, which I have with me in the market, the future rate is 1.9880. So the difference between these two will be my gain and loss. Because I already have a future, contract of 1.9556. And the future rate on that date after 2 months will be 1.9880. So this is the situation. Now, number one, what am I going to do? I'm going to sell the contract. So I make a contract to sell future equal to $11 million at 1.9556. And how do I sell it, by the way? Do I have it with me? I don't. On that particular date, I will buy it from the market and sell it to someone, because I made promise with someone, I will give you $2 million at 1.9556 future rate. So on that particular date, he comes in, knocks the door, Mr. Ali, you have to give it to me. So I have to sell him. How do I sell him? I don't have it. I go to the market and I buy it. I will buy it at 1.9880. So my buying price is 1.98 and my selling price is 1.95. See, there is a loss. Actually, while settling this transaction, I'm making a loss. This future transaction, forget about the spot market for a moment. Forget about the spot market in the moment. This future transaction actually is going to give me a loss. Number one thing, I decided in the very beginning, I said, is it a buy or sell contract? And we said, we need pounds, which means we need dollars. In order to get dollars, we have to sell sterlings. So I entered into a sell contract. To settle my sell contract, I have to do the opposite. If I go back, step number 3. Doing the opposite of what you did in step 1. Doing the opposite. So I have to actually now, what I need to do, I'll explain you what will you do with the spot market, but let me just tell you, because I said that there are 2 ways. One is spot you will buy, and one is future you will settle. There will be gain and loss. So what is happening? I can see that I have to sell something. Selling something for $1.95. Anything. It is potatoes. It is not dollars or it is not something. I have to sell you potatoes at 1.9556, but the market price of potatoes is 1.9880. So what I'm doing, I'm purchasing potatoes at 1.9880 and I'm selling you at 1.9556. So whenever the sell price is lower than the buy price, you are making a loss. So you make a loss here. It's very clear from the data. I have not started solving the question, by the way. It's been 20 minutes. I'm speaking and I'm saying I have not started solving it. I'm just understanding the question. So it's a loss on the future transaction. If it is a loss, absolute necessary, there would be a gain here. I'm 100% sure there is a gain here. I mean, this is what we have been discussing. Do you want me to find the gain? Yes, I will. See, what did we say? We said 11 million. If I talk about today's rate, 1.9615, how much it makes me? Divided by 5,607,000. So 5.61 million. You need 5.61 million sterling. You needed it on 31st of December. 2 months later, when the time of actual payment comes, the price of the dollar has become 1.990. Okay. That makes me 5.52. 5,552,000 sterlings. So actually, I need less sterlings now because the dollar has not become stronger. The dollar has become weaker because at that time, 1 sterling, it meant $1.96. $96. Now, 1 sterling is equal to $1.99. So in 1 sterling, you are getting more dollars. So sterling has improved. So that is actually totally opposite what we expected. You see here, you had 1.9615. Prediction was that it will go down 1.95, but it went into the opposite direction. So you said, oh, that's really amazing. If I had bought these dollars in December, I would have paid 5.61 million. But now I'm only paying 5.52 million. So I am the happy person. You actually are making a gain here. You actually are making a gain in the spot market. But unfortunately, some of that gain will be taken away by the loss here, which you are making on settling the future. And when you, so this is plus, this is minus. When you make this plus minus together, that will actually, you would not say minus this one. So you will write down this money, 5.52 million plus your loss here. And that together will be called your outcome. Because I'm not adding. So plus minus means if I add gain and subtract loss, then you can do it. So I'm just adding the net amount, 5.52 million. This is what I actually would pay to get $11 million. Plus I have some loss on my future. So this is, I mean, the working for calculating the futures, and the same working will apply into your options thing, except that in options you have premium as well. So in option, you only need to decide, okay, let's put it like this. In option, what will happen? So what did I do? I write down my purchase of my dollars plus my loss, and that's all. In options, what I will do, in options, I will say, this is my actual purchase from the spot market plus my premium, and loss I will ignore, because if it is loss, I will let it lapse. If it is gain, I would subtract. Gain is my benefit. So if I have to find out the outcome, if I have to find the outcome in option, What I do? Oh, I will go to the spot market. I will purchase the dollars. What is the purchase price of $11 million? I put it there. How much premium did I pay for getting the options contract? I will add that premium. If there is a loss, I will ignore. If there is a gain, I will subtract from the total cost, because because this is my cost, purchase is my cost, premium is my cost. And if I execute the options transaction, and there is some gain, I would subtract that gain. And this is what you call the outcome, the total net impact. Okay. So let's start doing this question now. I just explained the topic again. So this is here. Then they said required, find out, calculate the outcome of using a future hedge. So what do you do? Step number 1, identify what type of contract you are going. So it says that type of contract, the contract currency is sterling, and spender will need to sell sterling to obtain the dollars. So contract is to sell contract. Always, like I said, think like home currency. Always think in terms of home currency. You need dollars. You need dollars. But need dollars means that you need to buy dollars. But then don't say that it's a buy contract. Contract is not for buying dollars. Contract is for selling. Contract is for selling sterling. This is what you have. Okay? This is what you have. If I've got a car and I need cash from someone. So what is the contract? Contract is I'm selling my car. So contract is to sell the car. Okay. Contract is not to buy the cash. Contract is to sell the car. I'm selling my car. So I'm selling my sterlings. This is what I have. I cannot have a buy dollar contract. I mean, I don't have dollars with me. I've got sterlings with me. You only buy or sell something which you have. Anyways, it's a sell contract. Number 2, choose which date. We are going for March. We agreed on that. Number 3, what are the number of contracts you need? Step number 3, find out the number of contracts. So contract size is 125,000. March rate is 19556. So $11 million divided by 19556 when the contract is, you need 5,624,000. So then when I convert my 11 million into sterling on the March rate, it is 5.624 million sterlings. So this is the amount which you have to sell. Because you enter at this rate, you will be selling sterlings at this rate. So how many sterlings do you need to take out from bank and sell at this rate to get $11 million? So on that date in 2 months later, I actually need 5.624 thousand sterlings out of my bank. Notionally, it will not be out of the bank, but notionally. Imagine, take out from my bank, give it to someone at this price and get $1 million. And this 5,624 divided by the contract size of 125, you need 45 contracts. So number of contracts, you also calculate 45. So what happens? That spender company will need to enter into 45 contracts to sell at the rate of 1.9556. So I'm selling 45 contracts of 125,000 sterlings each at 1.9556. This is my agreement. Step number 2, in February, when the actual date will come, I will go to the spot market and I need to buy the dollars. And spot market says dollar is 1.990. Well, I will buy 11 million at 1.990, which makes me 5.52 million. So this is what I pay into the market. Actually, 5.527 million. The cost is lower because the pound has strengthened. This means that a loss is likely to be made on the future contract. Pound has strengthened. So you actually are paying less here. So if you are making a gain here, you will make a loss on the other side. Let's calculate the loss there. The loss on the future contract at the same date. Step number 3, in February, I have to reverse my transaction. I have a contract. I had contract to sell sterlings. I need to enter into a contract to buy sterling so that they cancel out each other. It is just like I promise someone I will sell you. Now I don't want to sell them. I buy from the market and I give them. This is what is happening. Because see what happened. I wanted to buy sterling. I'm sorry, please pay attention. I'm redefining it again so that you don't forget it. I want to sell my sterlings and get dollars. When I will go to the open market, I don't know what will happen there. So I make a contract with someone else as well that I will sell you my sterlings at 1.9556. And they agreed. When the time comes, I have no intention of selling them. I take my sterlings, come to the market, and I buy from the market at 1.999 whatever, and I get my $11 million. This person is still knocking my door. Mr. Ali, you promised to sell me sterlings. Give me the sterlings now. I say, oh, I don't have sterling because I already have bought the dollars from the market. This is a notional thing, imaginative thing, but this is how it works. So then I buy the sterlings from the market and give it to them. So actually, I'm not buying the sterling. I'm just buying the contract. So because I made a promise to them that I will sell you sterlings, now I have to buy the sterlings. I promised to sell at 9.5, but I'm actually buying it at 1.98 and then giving them for 1.95. I'm making a loss of 0.324. 0.0324 on each value. Then how to calculate the total? So 0.0324 on one contract, $1, 1 pound, 1 pound actually. Each contract is 125,000 pounds and there are 45 of them. So this is per pound. This loss is per pound. Per pound loss because pound was from 195 to 198. My total loss is $182,000. $182,000. You can calculate it alternative. This is alternative. 12.5 per take, number of takes, number of contracts, the same number. So outcome is this 182,500 is in dollars. I convert it in the February spot rate. Very important that this is the loss on dollars value. You convert it into sterlings, 1.990, the spot rate in the market. It is 91,000 pounds loss. So my total cost comes out to be 5527 million plus my loss of 91,000 pounds. The total cost is 5.619. So I actually ended up paying 5,619,221 sterlings. Okay. Now, if you want to see that what is the effective rate which you have got. Now, what do you get from here? 5.61. This is what I actually have to spend in my sterlings. So 11 million. If I divide it with 11 million, I'm just doing it for myself. I want to see the effective rate. Divided by 5,619. This is 221. Divided, 11 million divided by 5,619,221. So actually, I'm ending up with 1.9575. 75. This is my effective rate. Although I did get 1.99 rate, but some of that went into my loss. Remember, gain and loss are settling each other. You actually got a rate of 1.99. But after getting 1.99 from there, you made a loss of 91 as well. So the effective rate, effective exchange rate for this transaction is 1.9575. Now, let me tell you, why did we do that? You said, Mr. Ali, why did we do that? Come here. What is the rate as of today, spot rate? $1.96. And I have come close to 1.95. Market is moving dramatically. Market goes up 1.99. It could have gone down to 1.49. I don't know. It's not in my control. But by implementing this risk management procedure, I'm actually fixing it quite close to my current spot rate. And I'm not taking a very big movements there in the market. If market could go 40 degrees on the left or 100 degrees on the right, I don't know. But by implementing this movement, because what happened, that there was an upside movement and then there is a downside movement, somewhere I'm ending up very close to the current rate. 1.9615, 1.9575. So I'm not prone to some erratic currency or exchange rate movements because I have built in that future thing. If it had moved the opposite way, probably if it had not moved to 1.99, it might have moved to 1.69, let's call it 1.69. Oh, that would have been terrible for me. It would give me a lot of loss because in that case, I would need not 5.5 million, probably I would be needing 6 million sterlings to buy 11 million pounds. So I should be expecting a loss, but this loss would be compensated by the future because that price would move opposite. So by implementing this future thing into your system, you are actually closing the road. I'm not saying that it will remain same. Something with either it will be ending up little bit gain or a little bit loss. And by the way, here it is a little bit loss overall from the current scenario because you made huge loss on future settlement. The future settlement is 91,000 pounds, which was a huge thing. 91,000 pounds, you made a loss. Any question until here? So this same 3-step procedure, you will apply in options as well. But in options, you have to consider that 2 things you additionally have to consider. Number 1, are you going for a buy option or a sell option? I mean, call option or a put option? And number 2, just to include the option premium as your cost. So you will say, what is my cost? My cost is purchasing them at the market price. Not this one. I purchase them at the market price. This is my cost. Plus the premium I pay. And if there is a gain, I would subtract. If there is a loss, I will ignore. That's all. In option, you just need to add this one, premium. Anything else? Please ask.